Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, I've been jumping in a lot about investing this morning. I was going to try to get through the stack, but I can see I'm going to have a hard time. But this is one of those areas that is so important, and I see people make so many errors in it, taking on more volatility than they need to, and they have it built into their portfolios, this risk that we will go through another. I mean, statistically, 1 in 4 years are negative years in the market. Again, we're in the second longest bull market in history. Think of these things too. Now in the 80s and 90s, so there were two biggest back-to-back decades in the history of the stock market. Then we had the 2000 through 2009 period where we had one of the worst decades in the stock market. Now since then, over the last 8 years, is remembering the lessons of what, you know, how this works over the last 30, 40 years, right? And how that one, being realistic about what kind of return you're going to get from that, from your investments. Two, how to in fact invest so that you're prepared if the market does go through a downturn. You're going to be protected. It's not going to, you know, put you in a situation where maybe you have to, if you're already retired, where you'd have to go back to work, or you know, where you have to cut back on your lifestyle in some way. We don't want to do that. We want to be able to maintain that standard of living, and how you put together your overall plan will allow you to do that. All right, so it's one, if you can get the investment plan up front, if you can get that set right, you can help protect yourself, but there are other strategies that can be employed. So when it comes to investing, I mentioned the amount of stocks you have, of course, is going to determine the amount of volatility. And this, again, the more there are other factors, as I mentioned, long-term bonds, junk bonds, things that you may not even know are in your portfolio because they don't say that. It doesn't say, here's this junk bond fund, right? It'll typically say high-yield corporate bond. That, if you look in a high-yield corporate bond mutual fund, you're going to find low credit quality bonds. That's the way it works. The other thing is it just may say I won't use names, but it could be a, you know, XYZ income fund. Or a bond fund, and it may not even say long term. It may say investment grade. It could say any number of things. But when you look inside, that's where you're going to find and that's what I do when you come in to my office. When I meet with new clients, we do that investment analysis for them. I pull Morningstar reports, and on these Morningstar reports, I can look within the mutual fund and see what the holdings are. So I can see what kind of stocks, what the volatility, the standard deviation is. So I share this with clients when they come in and we do this the investment analysis for them. I share with them, here's what's in your current portfolio. These are the risks that are there now. And these high yield bonds, these junk bonds have done okay right now because of the interest rate in the economy. Same thing with long-term bonds, because interest rates have stayed so low, you're not getting hurt. But when that changes, those are the things that are going to collapse and they're going to take a beating. And that's where there's hidden volatility in here that you need to understand how that works so that you can plan for it. So if you're going to retire anytime soon, or you're already retired, making sure that you're not going to have your portfolio take a big hit and you're taking income from it, and it's not going to recover as rapidly as it might otherwise. You're going to go through your money, maybe cause you to run out of money, is a possibility as well. These are all things you want to protect against, and the way you do that is understanding how they work and then constructing your investment plan around protecting it, and then maybe even employing other strategies like fixed annuities as a way to add some stability, some guaranteed income. And then another, maybe we ladder the portfolios is another strategy we'll use, where we have a conservative portfolio for short term and then more aggressive portfolios for the longer term. So these are all some strategies. And if you're one of the first 10 callers to my office this morning at 615-376-5325, I will help you with this. I'll do an investment analysis for you as a part of your income plan, your comprehensive financial plan. So again, first 10 callers, 615-376-5325. Tess is standing by to take your information. She's going to send you out a little checklist of things to bring to your appointment with me. And for those that come in to see me, I will give you a free copy of the book when you come in, 7 Steps to Financial Freedom and Retirement. So again, first 10 callers, 615-376-5325. And we have a caller we're going to go to, and this is Milton. Milton, how you doing this morning?
Good morning, Hank.
Welcome to the Retirement Report.
Okay, thank you for taking my call.
How can I help?
I've been watching you, and one of the things that I'm really concerned about now is the 401k. My wife and I both have one separately, and we both are retired, and we're 64 and 65 respectively.
Okay.
We know that the age 70 is coming up where they're going to make us take it out. I think it's 70 and a half. Is that correct?
That's correct, yes.
Okay, and I know they're going to make us take, and we're worried about being going over that tax bracket, and we're just really, really concerned about what to do. Yeah. And one of the things, and like I said, I've been watching you for the last few weeks now, and I want to come in, but I don't know your scale for how much we would have to pay, because you don't want to go buy a car and bring it home, and the salesman say, "Hey, this is what it's going to cost you," and you don't find about it till you get home. So can you help me with that?
Sure, absolutely. Here's the way it works. First off, again, as a registered investment advisor, I'm a fiduciary, so I put my clients' interests ahead of all others, including my own. That's the legal standard to which we're held. Number two, when it comes to the free offer that we put out for the week, if you're one of the first 10 callers, you come in, I'll do up a full plan for you at no charge. Now, yes, I can't stay in business if I just give everything away, so I do limit it, number one. Number two, I will then show you the portfolios I use, and my advisor fee is very similar to what you'll find in the marketplace today. It's a graduated scale depending on how much you invest. It starts at about 1%, or it starts at 1%, and then it goes down depending on how much money you have invested. That's one area. There are other areas too that we get into, but there are when it comes to cost for planning, when we do that for those that come in, there's no charge for that. So again, I put that out each week, and I want to offer that to people as a way to help, and also as a way for me to show you the differences between what you're doing and what you could be doing. And and that's where when you see that difference, most of the time you're going to see the value to you, and of course you'll probably become a client. Now, if as a client, that's my fee in the investment side of things. And it depends too on other things we're going to look at, Milton, as far as costs go. There are no charges though then for the planning or anything. I do that as a value added for my clients. So when you come in, you'll get all the planning. I'll talk to you about RMDs, how they work, required minimum distributions. I'll talk to you about strategies of how you can, ways that you can reduce Roth conversions. May be something that would work in the short term, where it basically depends on if you're in the 15% bracket now and we've got some room within that to work. That's what we're going to do. So if in the case that, from what you're saying, if you reach 70.5 and those RMDs are going to push you into a 25% bracket, what are some things we can do now to keep you in the 15% bracket even after that happens? And there's strategies I'll show you to do that as well. But then as a client, I do regular reviews. So that means that at least twice a year, and sometimes more frequently, depends on the need of the client, because if you want to see me more frequently, or if things happen in life and you need to come in and talk about them, we always do that. But minimum I like is at least twice, so we can do some tax planning as well as reviewing the financial plan and making sure we're staying on track as life happens and different things come your way. So that's the way it works. Did that cover it for you?
Yes, it did, and I do definitely understand that you have to make a living. That's definitely not a problem. When you said 1%, is that 1% of the total income that we bring you as far as our retirement and 401k?
No, exactly. Great question. No, only on the invested amount. Only on the amount in the portfolios that I manage. If there may be other monies that you have in different places, or you may have. I've got clients that have rental properties. I've got clients that have cash or different other holdings that they have. I help them with that stuff. No, that fee does not apply to things other than specifically those things in the portfolio. If you're, on a 401k as an example, sometimes someone's still working, they can't, do anything with that 401k. I'll help them with asset allocation again on that. And again, I don't charge for only for the monies that are in my portfolios or in the investments that I recommend.
Okay. Well, I'm going to see about making an appointment, and I look forward to seeing you.
I'll look forward to seeing you as well. You have a good day.
Thank you.
Bye-bye.
Bye-bye.
All right. And we have William. William, welcome to the Retirement Report.
Good morning.
How are you today?
I'm fine, thank you. My question is this. If one is looking to leave a legacy,
right,
that is to say leave money for the heirs, what should the portfolio look like in terms of aggression and how many stocks and so forth?
It's a great question. One of the things when it comes to legacy, if you've got money that you're going to set aside and you're saying, well, this money I'm never going to touch, so therefore my time horizon is my lifetime, and then depending on who it's being left to and what it's going to be, how it's going to be used by them, it could potentially be over their lifetime. So the time horizon is what we look at, and that's where an example when we talk about aggression or being aggressive in investing. I want to be very clear. When I'm talking about aggressive, it's just the percentage in stocks, and I'm still looking at that very well-diversified portfolio that's going to have typically 10, 12, maybe even 15, 16,000 different companies in it, depending on the portfolio and what we're looking to accomplish. So it's going to be extremely well-diversified, number one. Number two, then now when we're talking about that proper asset allocation in place, then the only other thing that's going to matter is how much is in stocks. Do I have 50% in stocks, 75%, 95%? What's the right amount, and how aggressive do I want to be? The more I have in stocks long term, and it's very important, long term, the higher return I would expect to receive, because stocks outperform bonds over the long haul. Now, when it comes to legacy, then, if that's money that I say, well, it's going to stay invested for at least 10 years or 20 years or 30 years, then that would be the determining factor for how much in stocks. And then, of course, risk tolerance is another piece. How comfortable are you with the understanding, because you got to stay disciplined with this volatility. If you understand that you've got, as an example, let's say, a portfolio with 12,000 stocks in it, very well diversified. We know 12,000 companies aren't going to go out of business. So we're not going to lose that money. It's not going to go away as if I own one stock like GM and they go bankrupt and my stock is absolutely worthless and I just lost 100% of my money. That's a speculative bet when you go one stock. Follow me so far on that, William?
Yeah.
Okay. So we want to avoid I'm doing this because you may be very knowledgeable, but I'm talking to a lot of people and I want to make sure everybody understands how this works. So we'd be very careful that if we're starting again with proper asset allocation, not a speculative bet, then that piece comes in about the volatility and staying disciplined, because I don't want someone that's holding 2 or 3 stocks taking this advice that I'm giving to you today and thinking that it applies to them, and that if that drops down that they can just hold on and it'll come back. Some stocks or some mutual funds don't come back, which is why having more of them, again, 10 or 12,000 stocks, now I'm protected against those kinds of things. All right, now back to your question. How long is the money going to be do you intend to keep it invested?
Well, how long are my kids going to live as far as extended time horizon is concerned? I don't know.
All right.
I expect to pass a good portion to them.
All right. So let's say you identify the amount that's going to go to the kids, and you want that to, and you're looking at it being more aggressive. Let's say at least 10 plus years, right?
Yeah.
And you feel pretty comfortable with stock market risk, with the volatility?
I do.
Okay. So you know that over the long term you're going to be okay. It'll just ride it out. So in that case, the next piece would just be, I would look at a needed rate of return. I do in the planning that I do with my clients, for instance, we look at how much we want this to grow and what's the kind of rate of return can we realistically expect. And I can show you on the portfolios the historical performance, and therefore, what that would look like so for an example, if I look at a 40-60 portfolio like the one that I use with my clients, that 40-60 portfolio over the last 10 years averaged about 7.5%, comparable, in fact, almost exactly the same as the S&P 500 index. But the standard deviation was about 7. It was less than half that of the S&P 500 index. So now that's a 40-60. So that's pegging in around 7.5 for the last 10 years. If I look at a 60-40 fund, I reverse it, right? Now I get 60% stocks instead of 40. Now it averaged about 8.7% was the average return over the last 10 years. And the standard deviation, I think, was around 10, if I remember right, or 9.7, something like that, pretty close. So about 2/3 the risk of the market. So the more I add into that stock piece, the more I would expect that return. Now, when you're getting up in that, not always, you can get real aggressive with stocks and the return isn't going to all of a sudden jump into double digits. Maybe in short terms, like we've had in the last, since the election, or even since from 2009 on, we've had a nice run. So you might see some good returns from that standpoint if you just looked at a more narrow, like just 8 years of just only bull market. But I would say to you, if you're going to look at investing realistically as far as returns, I would be looking at least 10 years back and ideally even 20 years back, taking the last 2 bear markets along with 2 bull markets, and I think you're going to get a better average as far as what to expect on return. And then how aggressive is the next piece, is how comfortable you are. And understanding, again, how it works as far as portfolio. Do you do your own, or do you have an advisor now?
I do my own.
So do you use no-load funds?
Absolutely.
Excellent. Do you use index funds?
I have both.
Okay, I would show you when I do when new clients come in for the first time and we're going over their portfolios, I get into a big thing about how the difference and I'll show you a lot more proof. I do it on the show all the time, but just as I just shared a couple of articles about how indexes beat active managers 92% of the time, and of the 8% that beat the market, it's not consistent. It's not the same people. In other words, if it was that, let's say there was a top 8% of money managers that always beat the market, well, then that would make sense to go with that. But what we find is that some money manager just happens to get lucky over a given period, all right, beat the market, and we know that because when we look at them at, let's say, the last 5 or 10 years where they beat the market, and then we were to look at a 5 or 10 year period after, and there's a lot of studies like this that show this, we see that the same money managers don't repeat. So then we know that they just happen to have the right thing at the right time. Active management, time and time again, has been proven to be not to do as well as indexing or institutional index funds will do. And again, asset allocation is going to be the biggest determinant, not active management. But if you want to come in and take a look and do more of an analysis, I can share more with you about that. All right?
I'll give it some thought.
Okay. Well, did I answer your question well as far as how aggressive?
Well, I'm going to have to think about this some more. So.
All right. Well, one of the things, again, it's all about the stock, but asset allocation is the biggest key there first. Starting there, then adding in that percentage of stocks in terms of aggressiveness. And here's again, if
there's a difference. If I'm going to leave a legacy, that's one thing. If I look to take money from this for living purposes.
Exactly. If you're taking money, then it's going to be different because you're going to be less aggressive. All right. Well, or you're going to employ different strategies. So I might have a conservative portfolio with 25% stocks for money I'm going to be using over the next, say, 3 to 5 years. Okay, so that's going to have much less volatility. I'm not going to have to worry so much. I may even have some money set aside in a fixed index annuity as an example that can provide me income in the short term. In other words, I want to keep that short term 1 to 5 year period much safer, much more stable than money that's going to be 6 or more years. Then I might get into a moderate portfolio for my 6 to 10 year period where it could be anywhere from 40% stocks to 60% stocks, depending on what my needed rate of return and risk tolerance are. And then I can get more aggressive for monies that are going to be in there 11 plus years. So a lot of times it's about laddering or blending together different strategies to accomplish it as well.
Yeah.
All right?
Thank you.
All right, you have a good day.
Bye.
Thanks, bye. All right, we're going to take a break. Join me here, or we'll be right back on the Retirement Report.
Are you getting love letters from the IRS? G'day, I'm Dr.